Growth stocks had their moment in the sun, and then the sun went behind a cloud, and some investors are still standing outside wondering if they forgot sunscreen. We need to talk about one of the oldest debates in investing: growth versus value, and why getting this wrong could quietly cost you more than you think. Let's start with the basics, because the definitions matter more than most people realize. Growth investing is essentially betting on tomorrow you're paying a premium today for companies expected to expand revenues, earnings, and market share at an above average rate. Value investing, on the other hand, is the art of finding a dollar bill, selling for 70 cents, buying what the market has overlooked, underpriced, or flat out ignored. Think of it this way. Growth investing is like buying concert tickets before the band blows up, while value investing is like buying their vinyl record at a garage sale after everyone forgot about them. One requires vision, the other requires patience, and both require a stomach strong enough to handle being wrong for longer than you'd like. The 1990s and early 2000s were a masterclass in what happens when growth conviction runs completely off the rails. The dot-com bubble saw investors pouring money into companies with no earnings, no revenue, and sometimes no real product, just a dot-com at the end of a name and a dream. Then came the crash, wiping out trillions in market value and reminding everyone that growth without fundamentals is just a story with a bad ending. Value investing had its hero in those years, Warren Buffett, who famously avoided tech stocks during the bubble because he couldn't understand the business model. He looked foolish for a while, then looked like a genius, which is basically the entire value investing experience compressed into a few years. The lesson wasn't that growth is bad, it's that price always matters, no matter how exciting the story. Fast forward to the post-2008 era of near zero interest rates, and growth investing went on an absolutely historic run. Companies like Amazon, Apple, Tesla, and Netflix became household names and made early investors wealthy beyond imagination. The kind of wealth where you stop checking prices at restaurants. But here's the irony. Low interest rates were essentially a cheat code for growth stocks. Because when you discount future earnings back to today at nearly 0%, those distant profits look incredibly valuable. Then rates started rising in 2022, and the music stopped. Growth stocks got absolutely hammered, with some formerly high-flying names down 50, 60, even 80% from their peaks. Meanwhile, boring, beaten-down value sectors like energy and financials quietly had one of their best years in decades, and almost nobody was talking about it. Here's the misconception that trips up so many investors. They think you have to pick a side and pledge your eternal loyalty like it's some kind of financial religion. The truth is that most sophisticated investors and institutions blend both approaches, adjusting the balance based on market conditions, valuations, and where we are in the economic cycle. Diversifying between growth and value isn't a compromise, it's a strategy. History gives us a useful framework here, even if it's never perfectly repeatable. Value tends to outperform during periods of rising rates, economic recovery, and when growth stock valuations get stretched to absurd levels. Growth tends to lead during periods of falling rates, technological disruption, and when the economy is expanding and investors are feeling optimistic. Knowing this doesn't let you time the market perfectly, but it does help you avoid being caught completely flat-footed. The practical lesson is this: don't let recent performance dictate your entire strategy. If growth has crushed value for 5 years, that doesn't mean it will for 10. And if you pile into whatever worked last decade right at the peak, you'll experience the painful lag that reversion to the mean has delivered to overconfident investors throughout history. Position size and diversification are your shock absorbers when your conviction turns out to be early or just plain wrong. There's a beautiful irony in how both camps argue with each other on financial Twitter like they're mortal enemies, when in reality, the best investors quietly steal from both playbooks. Peter Lynch, one of the greatest fund managers ever, talked about buying growth at a reasonable price, essentially blending both philosophies into something he called GARP, or growth at a reasonable price. The market doesn't care about your labels. It only cares about whether you bought something for less than it was worth. The emotional discipline required here is genuinely underrated. It's easy to be a value investor when value is winning, and easy to chase growth when tech stocks are printing money. The hard part, the part that actually separates long-term wealth builders from chronic underperformers is sticking to your process when everything around you is screaming that your approach is obsolete. Discipline isn't glamorous, but it shows up in your portfolio statements in a way that conviction alone never will. At the philosophical level, both strategies are really just two different answers to the same question. Where is the market wrong right now? Growth investors think the market is underestimating how big a company can get. Value investors think the market is overestimating how bad things are for a beaten down business. Both require independent thinking, rigorous analysis, and the humility to accept that you won't always be right. And that's okay, as long as your sizing reflects your uncertainty. So here's where we land. Don't marry a strategy, marry a process. Use growth and value as lenses, not religions. And let valuation discipline guide your decisions regardless of which camp a stock technically falls into. The investors who build lasting wealth aren't the ones who picked the right style. They're the ones who stayed consistent, sized appropriately, and never let a good story override a bad price. And whether you're thinking about building wealth through equities, real estate, or home improvements that boost your property value, we can help you take the next step. Check out our links in the description below to get connected with real estate investing resources, trusted contractors, and experienced lenders.